What I would like to cover in this video are just different methods that you can implement for observing the stock market. If this is a concern of yours, stay tuned. I have some answers for you. Before I start on this video, I want to remind you that I have a free workshop that is available to you by clicking on the link in the description box below this video. It's about 90 minutes long. I'm not trying to sell you anything. I'm just trying to offer you some insight and different ways that I think, and to help you possibly think in different ways yourself. The coverage includes a lot of different areas. Of course, I talk about the financial markets in general and a little bit about the stock market itself. I also cover sports. I'm a big fan of sports. Music. I've been playing music since I was very young. And I also talk about professional and personal relationships. The goal of this workshop is to help you to think in either new or different ways, as well as for you to get to know me and my style. So when I'm talking about constant observation, I have found that it's one of the best ways to understand what is happening in the stock market by always watching what is happening. A very useful tool can just be the tool of observation. Just watch what's going on around you. You'd be surprised at how much you can pick up. This does not mean being stuck at a computer screen all day or all night. Some people actually do this. But it does mean checking on things no matter if the market is open or closed. And I'll explain more about that in a minute. The time that concerns market participants the most is from 9:30 a.m. Eastern Time until 4 p.m. Eastern Time. And you might have to adjust this depending on your time zone. These are the central hours of operation for the U.S. stock market. This is when you enter or exit a position. However, with the benefit of technological advancements, this is not only allowed for the markets to be active virtually 24 hours a day, 6 days a week, it is also allowed for any individual to keep up with what is happening. Here is some of the technology that we can use to help us. Smartphones, high-speed internet, useful apps, and easy-to-access data, much of which is free, allows an investor to keep an eye on things quite easily. This is a lot easier now than it used to be. All these advancements have really helped us. The main requirement is having an internet connection. The nice thing about being involved in the financial markets is you can be anywhere in the world. You can travel, you can be in one country during one period of time, you can travel to a different country, you can travel around the US. As long as you have an internet connection, you're set. Each market participant will develop their own routine, so this is up to you. You're just going to take what I say in this video, apply it to your situation, and then the hope is that you develop a routine that works for you. But to be successful, each must include watching the markets as part of your daily activities. You have jobs, you have families, you have obligations, you're busy. The nice thing about using technology is we can still do those other things, but using our smartphone or a laptop, we're able to keep in touch with what's going on while we're doing these other things. This can be rather effortless by just glancing at a smartphone or computer screen periodically. If you work in more of an office environment where you're around a lot of computers and you're allowed to get on the internet, take advantage of that. If you have a smartphone and you're out and about, or you don't travel all that much, you just have your phone with you all the time, you have apps and different ways of being able to check things online, you can take advantage of that. It can require more effort, such as watching videos or by reading an article, blog posts, or a book. So there are times when we have to go old school and do things the old-fashioned way. But for day-to-day observation of the markets, we can use technology to our advantage. So let's talk about developing a skill. The point is to always be in tune with what is happening without it being a distraction from real life. If you're a musician, a large part of playing music successfully is listening to other people. Not just other groups, but while you're playing, there's other people that are also playing music, and you're listening to them and playing yourself at the same time. Think of it that way. You're part of a band where you're just trying to figure out what you hear and then adjusting things accordingly. Market participants are often surprised by how much insight is gained just by watching things. My personal opinion is I think the powers of observation are very underrated. It's a skill that we've lost, and if you just sit and watch what's going on, you will be really surprised of what you can pick up. This is helpful when it comes time to make actual decisions. You may watch the market every day, but you may not initiate a position or close a position all that often. But still, having a feel for what's going on can be very helpful. Consistently observing the markets is critical for creating foresight. That's what we're trying to do here. We want to see things before they happen, if possible. This allows you to be proactive rather than reactive. When you're proactive, you're on offense. When you're reactive, you're on defense. And it's a lot more fun and a lot more gratifying and can be a lot more profitable if you are on offense. So developing a general routine. To provide an example, I will describe my usual routine each day the markets are open. I live on the west coast of the US, which is 3 hours earlier than Eastern Time. If you remember back, the market opens at 9:30 a.m. Eastern Time. That's 6:30 a.m. Pacific Time. Fortunately, I'm a morning person. I prefer to get up early after going to bed early. This is part of my nature. A lot of people don't have that same kind of nature, I realize that. Usually, I wake up about 4 to 5 a.m. This is 1 to 2 hours before the U.S. stock market opens at 6:30 Pacific Time. I have a laptop and a smartphone nearby. What I usually do first is I will check my emails, any private messages, posts on Facebook, things like that. However, I also have several stock market related websites that are bookmarked and software that I look at immediately, and I'll share a little bit more of that with you later in this video. So what are some observations that we can make before the market opens? Over the last 10 to 20 years, the markets have become more global in nature. When I first started back in the mid-90s, I was really only concerned with the US market. We heard a little bit about Europe, a little bit about Asia, but not very much. I really didn't focus on that until about the last 10 to 20 years. And that's growing almost at an exponential rate now, where things that happen in other countries do affect the stock market in the US, but we have to know what will have an impact and what will not. When it's early in the morning on the West Coast, the Asian markets have already closed for the day. The European markets are near the close or in mid-session. Paying attention to the stock markets in other countries has become necessary. Before that, it was interesting to know what was happening in other markets, but not necessarily imperative. For the most part, that is still true today since the US has the largest, most developed, and most influential stock market in the world. It's considered to be the king of the financial markets. There are times when things that happen in other countries will have an impact. When everything is said and done, the US is still the king when it comes to stock markets. However, there are times when events in China, or the EU, or in any location for that matter, can impact US stocks, especially at the open. Let's look a little bit at Asian markets. First, I look at the most important Asian markets, and this is changing over time. I look at China. I used to not even pay attention to China, but now I do. Japan, which has always been important, as well as Hong Kong. Depending on current events, Asian markets may have an impact on US markets. At other times, there's no impact at all. We don't really know. The markets will decide what they want to fixate on and what they can just comfortably ignore. Japan and Hong Kong have always been important, especially since the Asian currency crisis of 1997. Some of you who've been investing for a while may remember that. CNBC was doing live coverage of when the Asian markets opened and everybody was all freaked out about it. Well, eventually that crisis went away, only to be followed by other events that have happened. For a long time, I did not even realize China had a stock market. due to its communist form of government. However, as China has adopted some capitalistic methods, the Chinese stock market and the various exchanges in China are worth watching. If any movement in an Asian market appears significant, I will look for any news related to those markets. A lot of times I can just go to Google and type in China or Japan or Hong Kong, and the news articles will come up immediately. At the same time, I am looking very closely at the stock index futures. Next, I look at the European markets. As with Asia, for many years, it was somewhat interesting to know what was happening in the European markets, but it was not really all that important. This has changed. Often, the European markets will set the tone for the US Open. That's not the golf tournament. Sometimes this can carry over for the entire day in the US, while other times it may only last during the first hour or so after stocks start trading in the US. The main indexes that I look at include the DAX, which is the German index, because Germany currently has the most influence in the EU. They have the most robust economy. I also look at the Euro Stoxx 50, which are the blue chips or best quality stocks in the Eurozone, the FTSE in London, and then the CAC 40, which trades in Paris, France. So let's talk about US domination. Even with the markets becoming more global, the US remains relatively independent and the true leader. Asia and Europe may have some initial impact, but the US market participants determine what will happen in the US. I've seen that many times where it looks like we're headed for a really strong open or a really weak open. The market opens in that direction, and after about an hour, that seems to get worked through the system and the market turns around and heads in the opposite direction. Most other countries follow the US rather than the US following other countries, at least over the long term. There are exceptions, such as Brexit that I mentioned, which started in 2016, the financial collapse in Greece, which began in 2010, the continuing trade disputes with China, and of course the COVID-19 pandemic. So how do we follow the leader? In fashion, Europe has always led the way, especially in women's clothing. Now, this doesn't necessarily have to do with ladies' fashion styles. North Face and Columbia jackets were popular in Europe about 5 to 10 years before they even became known in the US. Certain technologies may also catch on in Europe sooner than in the US. Just as an example, I was on a trip going through England one time, and I saw everybody on a train playing with their phones. And I thought, wow, that must be a really good game they're playing with. And I asked the person I was with, what are these people doing with their phones? And I was told that they are text messaging. And I thought, well, that's kind of silly. If you want to talk to somebody that bad, just call them on the phone. And then after I returned to the US, I was telling a few friends about this who also thought text messaging was pretty silly. Who would know that within a few years it would become a way of life for most of us? This has also been seen throughout history, such as with World War I and World War II. Both conflicts pretty much started in Europe and then flowed to other countries, and then later on the US became involved. I am a history teacher, so I kind of find these things interesting to study and to talk about. Also, in many ways, Asian countries tend to follow the US, which follows Europe. It's almost a global progress starting in Europe, gravitating over to America, and then finally moving over to Asia. Not with everything. Periodically, there has been an economic correlation between what has happened in Europe occurring before it happens in the US. Then it is followed by Asia. Again, this is not cut and dry. It doesn't always work this way, but there are patterns that we have seen throughout history, both economically, culturally, socially, and technologically. This is not always true, but good to be aware of and watch anyway. There are some countries that are just not that important when it comes to the stock market. From a stock market perspective, it may be surprising that certain countries are not that significant. This can include Russia, which is a main player when it comes to geopolitical events. Eastern European countries, they used to be part of the Warsaw Pact. Now They're more democratically based countries, still heavily influenced by Russia. However, their stock markets have really not gained a lot in popularity. Most of the EU countries, there are 27 countries now after Brexit, most of those countries are not that important as far as the stock market is concerned. Then we have South American countries, wonderful places with amazing people, but they don't have a big influence on the US stock market. Then we have African countries, and finally, Australia and New Zealand. There may be isolated events that can impact the US financial markets, but this is the exception rather than the norm. Typically, such events only make the news, but do not impact the US financial markets. But sometimes you would think an event would have an impact when it really goes unnoticed by the markets, and then other times something that you think would be unnoticed is what the markets become fixated on, and we're never really quite sure what that will be. What is more prevalent and needs to be watched is the interplay between the European central banks, the Bank of Japan, and the Fed, which is the central bank of the US. So what is watched? The idea is to get a feel for the general ebb and flow of the markets, just like you're watching the tide going in and out. One thing I want to point out is we're not trying to form opinions about these things. We just want to know what's going on, and we want to try to remain as objective as possible. We're not trying to pass judgment or come to any conclusions. We just want to take in all the information that we can. The stock index futures are the most important thing to watch, and this includes the S&P 500 futures, also known as SPX, the NASDAQ 100 futures, those are the 100 largest stocks on the NASDAQ, and it's often referred to by its symbol of NDX, and then the Dow futures, which are the 30 biggest stocks that trade in the Dow Jones Industrial Average. These are futures contracts that trade 24 hours a day, 6 days a week, and we can watch them all the time, even when the US markets are closed. There are free emails available. A few that I've found include Bloomberg sends out an email before the market open. It's called 5 Things to Start Your Day. Of course, I always have to wonder what happens if they can't come up with 5, or what happens if there's more than 5. BusinessInsider.com also puts out an email, and it's called the 10 Things to Know Before the Opening Bell. And then CNBC also sends out an email. The subjects of these emails mainly focus on Asian and European news, but can still be helpful. The goal is to not waste time reading fluff articles, but articles that provide insight into the stock market. Now I'll go through some websites that you might find useful. Quite often these are free websites that you can use. One is called briefing.com. I've used them for a long time. They have economic reports that are posted on that site and a calendar. They also provide stock market updates, which are updated regularly throughout the trading day and can be viewed on their website or by email. There's another site called investing.com. This is what I tend to follow the most, especially when the US market is closed. What you see on your screen right now is what I follow most of the time. It's at investing.com, and these are just the major world market indexes. We have the US markets listed on the top, and then all of the different indexes that you can follow, with China being located near the bottom. What I find most useful is back near the top, over here on the right-hand side, we can see what the futures prices are doing based on the Dow Jones Industrial Average and the S&P 500. We can also look at the dollar index, which trades virtually 24 hours a day. If I click here, I can also look at oil prices, gold prices, copper prices, different markets that can influence the US market. The ones that I look at mostly are the first page with the indexes, and then I follow the dollar index very closely, and then I might come over and look at the commodities. Another thing that this site provides, it's really kind of interesting, as cryptocurrencies become more of the rage. At investing.com, they also have a page where you can look at all the different cryptocurrencies, as well as access to different chat rooms. And I found this just to be kind of fun to do, and I'm just amazed at what some of these people actually say over here. They are so convinced it's going down or going up, or that selling is the right thing to do, or buying is the right thing to do. And then you get all these get-rich-quick folks that come in here promoting their products. And I never post. I never make any comments in this particular chat room. But it is kind of interesting just to follow through and see what some people, especially the people that are brand new at this and looking to get rich quick, the things that they can say and the questions that they have. Scroll down a little bit. There's a chart that comes up. This is a 15-minute bar chart. As cryptocurrencies become more and more prevalent in the financial markets, we need to pay more attention to them. I also go to another site called multiple.com, and this is based on a book called Irrational Exuberance, which some of you may be familiar with. It was written by Robert Shiller. It's a book I would highly recommend. But in conjunction with that book, he has a website where there are charts that are updated. Here is a look at Robert Shiller's website. What comes up first is called the PE ratio, and I have a video and blog article about the PE ratio. But if you go over here where it says more, there are all kinds of different stats, both on the S&P 500 and economic stats that you can look at. I don't necessarily look at these from one day to the next as far as what they may do. I use this when I'm analyzing things in a bigger picture. Another site that I found helpful is called seekingalpha.com. There are free parts and paid parts to that website. Sometimes you can find some useful information there as well. I also subscribe to the Wall Street Journal, and I can read any of the articles there. And then some of you, if you have an audible.com membership, you can get a podcast every day, either from the New York Times or the Wall Street Journal, where they read the main headlines for that particular day. These are not free. There are podcasts and things you can listen to that are free online. The important thing is finding a website that covers global markets and delivers stock index future prices in real time. That is the most important thing. Now we start looking at the open. What you'll hear quite often is that there will be some kind of a gap opening. Rarely does the market open exactly where it closed the previous day. This gap can be either up or down. If the gap is significant, usually over 0.5% up to 1% or more, there will often be an attempt to fill the gap during the first 30 to 60 minutes, and this could go on a little bit longer. It may last 90 minutes. Look for a possible fade, which means selling, if the gap is higher. You'll see that quite a bit. Will gap higher? A lot of the shorter term positions, people will want to sell those, lock in those profits, and so even though we gapped higher, you'll see a lot of selling after the open. Look for possible buying if the gap is lower. There's this famous method that people seem to learn really quick, and it's called buy the dips. Yes, that can be an effective strategy, but sometimes it can come back to really bite you. Unless you like to live on the edge, and this is what I would highly recommend, never attempt to trade during the open. We watch the first hour to hour and a half, but we don't ever initiate new positions, especially on Mondays. And if you think about that, it makes sense. Right at the open, you have all of the orders that have been placed since the previous day's close. You don't know what these people are doing. Are they buying? Are they selling? You don't know if there are big trades that will occur or small trades, and this can make prices really gyrate around. I tell people, watch the open, but don't ever trade the open. Some of you may disagree with that, and that's fine. If you found an effective approach to doing that, my hat's off to you. This is just what I recommend. The only time you might consider trading the open is if you're going to close a position, you were just waiting for a specific price. But you notice that there's going to be a gap in your favor. One thing to be aware of is there are many day traders and short-term trading methods that involve trading against the trend. I've run across these I don't know how many times. If we're going up, they're looking at going short. If we're going down, they're looking at going long. What they want to do is look for spikes or dips and then attempt to make fast profits by entering a position for only a few minutes. These are day traders. As much as we might slam them from time to time, they're an essential part of what we're doing. They add liquidity to the market. It can be a little bit frustrating, and it can go against what you think should be happening. They do play an integral part. This chart is just an example of what I look at during the day. It's a 10-minute candlestick chart. So each one of these bars is 10 minutes. I go back about 5 days just to give it a little bit of context. When the market opens, this updates every 15 seconds or so, and I get a fairly good real-time view of what's happening in the markets. What you see now is the stock chart's ACP. Personally, I only follow the S&P 500, hence the name SPX. Some of you may follow individual stocks. Some of you may look at different markets. This gives me kind of a big picture view of what's not only going on in the S&P 500, but over on the right-hand side, I get a map of what's happening within the market itself. I can look at different indexes over on the right-hand side. The market is currently closed as I'm recording this, so it's not updating. I can look at the different sectors within the S&P 500 and how they're doing, which sectors are up and which sectors are down. I'll also follow bonds pretty heavily. I look at interest rates. Are interest rates going up or down? That can be real influential in the stock market. Then they just recently started putting quotes for cryptocurrencies in with this tool as well. It's a good tool. There's other videos that I do, some that I do every day, some that I do every week, and some every month. And pretty much all of the charts that I use in those videos come from stockcharts.com. What you see now is a daily candlestick chart. One of the things that is very important is to not lose context. If we're looking at a 10-minute chart or a 60-minute chart, also look at a daily chart to maintain the proper perspective, because people think the way things are right now is the way things are always going to be. If we're in an uptrend, they think we're always going to be in an uptrend. If we're crashing through the floor, they think we're always going to crash through the floor. You can keep your wits about you by just maintaining a proper perspective. Then what do we do after the open? For the remainder of the trading day, I mostly follow the 10-minute chart, and it's a real-time chart, and it's a candlestick chart of the S&P 500 and the SPY, which is the ETF attached to the S&P 500. Other indexes that I follow, not as close, but I still watch them, are the Dow, that's DJX, the NASDAQ 100 or NDX. Then there are some small cap indexes that I follow, either the Russell 2000 or the small cap index put out by Standard & Poor's, and then the mid caps. There are certain things that can tell us what's going on and provide insight for us by watching these other indexes. If a significant move occurs that seems out of place, what I do is I will check the Wall Street Journal headlines. I'll go to Market Watch, where I have a subscription. I might even go to Barron's, even though it's a weekly publication. Bloomberg sometimes will have useful information. Then I'll go to briefing.com, which I mentioned earlier, or one of the financial channels, and I'll talk more about that here in just a moment. What are some other things that you can watch? Stock index futures, especially when the market is closed, but not so much when it's open. Other markets that I follow are the bond market that I mentioned a little while ago. I do follow the US dollar, and that's 24 hours a day, 6 days a week. The oil market, that can have a heavy influence sometimes. The gold market, which also trades around the clock. And just for fun, I watch the cryptos. Some of the financial channels. There are different channels to choose from. I rarely watch these channels anymore. Unless the open looks to be intense, there's a major announcement that's looming. Maybe the unemployment report is coming out or something is happening. A lot of times I find myself watching the financial channels less and less as time goes on. If price action just seems to be acting strange, I see a blip up or a blip down and it's more than just a buy or sell program generated by a computer algorithm, and things look to be really changing direction for some reason and I can't really figure out why, I might flip on one of the channels. Some of the channels that you may watch include Fox Business. I've found their business reporting has really improved a lot over the last few years. There's Bloomberg, especially when the markets are closed. They're really good at international coverage. CNBC, I watched CNBC religiously for years. I can't handle them anymore. They have become so political and so combative and so confrontational that it makes me really uncomfortable to watch them. I just want to be told information. I'm not looking to be entertained. I'm not looking for fights. I'm not looking to be told what to think. I just want to be told what's going on. And CNBC has switched how they do things. Another site that you may or may not have heard of is called Tasty Trade. I'll talk a little bit more about this site later, but this is a good educational tool, as well as some of you may find this as a good brokerage alternative. There's also some different software that you might want to implement. The software applications that I use include a thing called Thinkorswim, TOS, a software application that I've been using for over 15 years. I no longer use it to execute my positions, either opening or closing. I still get real-time data, and I can use it for insight. Thinkorswim was purchased by TD Ameritrade in 2009. I still have an account with TD Ameritrade, and I often have Thinkorswim running. Then there's Tastyworks, or TW, which goes hand in hand with Tasty Trade. It's a relatively new trading platform designed by the same people who originally developed Thinkorswim. There are useful charts, studies, and tools in both software applications. And using both is suggested but not required. Both apps are free but require a brokerage account. However, for new users, both of these apps can be overwhelming. Now we want to look at the close. One important aspect to consider, and this is my philosophy and what I teach, it's to consider entering new long or short positions as close to the close as possible. You'll hear me say this over and over again. It's the amateurs who open the market. It's the professionals who close the market. The idea is that we want to enter a position in the direction of our directional position. So if we've analyzed the market and we want to go long, which means we think the market's going to go up, why in the world would we enter in a position if the market is down? That makes no sense to me. If we think the market is going to go down, but the market is up, why in the world would we initiate that short position? We want to get on the momentum of what is already happening. Some of you are going to vehemently disagree with that, and that's fine. You think, well, if I can buy a stock at 10 and it falls back and I can get it for 9.5, woohoo, I got it on sale. I understand that. But to me, that makes no sense because we want to get involved in the direction that the market is moving. Why would you get into it when it's going the opposite direction? That's my philosophy, and that's what has worked for me. The last hour, especially the last 30 minutes, is often critical. This will determine if the plan that you developed before the market even opened will be executed or not. Now, this does not apply to what we call market neutral positions. These are positions that we use when the market's going sideways. There's really no uptrend or downtrend. You get into those when you can get into those, and you get out of them when you can get out of them. I'm talking about directional trades. For long-term investors, this may only happen a few times a year, if even then. Also, what strategies you implement will determine how often this is done. There are strategies that involve initiating and closing positions every week. Some may involve position changes every month, some every quarter. Then what do we do after the close? Once the market closes, relevant data is then available. Some of this is available right away. Some of it might take some time to get to you. This usually comes from your broker or a website or by email for checking the different status of your positions. No matter when it is done, it is important to repeat the same routine each day so it can be easier to execute any plans when the time comes to do so. Practice, practice, practice. If we're always in tune with what's going on, you'll find that your decisions become much wiser and much better, and your portfolio will benefit from that. Each day, apply, lather, rinse, repeat. What I'm getting at is make this part of your daily routine. Watching the market when it's open, watching the market when it's closed. Keeping an eye on things. If you just come in cold and now you have to make some kind of a decision, you're gambling at that point. You're not really using wisdom. You need to have the proper context for making decisions. So I want to thank you for taking the time to watch this video. Yes, here is one of my English-speaking students. I appreciate everyone taking the time to watch this video. Please click the like or dislike button below. And even though I know none of you are silly, you can leave a comment if you like and subscribe if you like. And you can also access a free workshop that I talk about in the description right below this video. So thank you again, and I'll talk to you in the next video.